Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Eric Metz, CEO of SpiderRock. Eric, it's great to see you again. Welcome back to Trade Talks.
Yeah, thank you, Jill. It's been some time. Glad to see y'all as well.
It has been. It is pre-COVID when we were still in studio, but here we are now working from home and still getting the job done. So let's catch up with where we are in the markets right now. With the S&P 500 registering all-time highs, volatility has been subsiding to pre-COVID levels. Where do you think we go from here?
Yeah, it's interesting. I think, you are correct in kind of volatility subsiding since the COVID era that we've been in since kind of March of 2020. I do think there's a new regime, though, albeit, pre yesterday, VIX closing in on new lows since the COVID era. You're finding a floor, right? So the vol regime here has definitely changed pre and post COVID. And so I do think, the new normal is VIX oscillating between 15 and 25. I think more to come on that. But yeah, I mean, obviously equities registering all-time highs, that's one statement, but the volatility regime is also as interesting.
So how are you positioning with options then? Is the cost of hedging prudent at this point?
Yeah, I think the interesting dynamic, again, yesterday shook up some of these dynamics pretty aggressively, but near-term options were becoming a lot cheaper than longer dated options, right? So the anxiety, the uncertainty in the marketplace in a longer time frame still exists, but the ability to afford near-term protection got quite affordable. And part of that reason is because, implied vols, the cost of the options, track realized vols, which had hit, what I'll call all-time lows, given the levels of VIX even earlier this week. So a lot of interesting, relationships really getting distorted. And I do expect some heightened volatility in the weeks and months to come.
Does the 60-40 portfolio have the same allure as the all-weather portfolio going forward?
That seems to be the question of the day and is becoming $1 million question. I think what's happened since the COVID regime is that, the flight to quality in U.S. Treasuries and fixed income, really paid dividends. And then for folks that were fortunate enough to rebalance, what's happened since is their equity markets have just outperformed so much that they're overweight equities, right? And the reluctance to rebalance here today is predicated on an incumbent tax liability. And we can talk about tax reform and maybe a subordinate conversation, but the reality is people are overweight equities either in a desired fashion or in a reluctant fashion. And thinking about the correlation between fixed income historically and equity markets historically, I don't think holds going forward given kind of where yields are today, right? The bond math just will not support that correlation that has historically boded so well for many investors.
So Eric, of all the catalysts that could potentially initiate a sell-off, and the market, of course, is always worried about something, whether it's COVID variants, geopolitics, inflation, what concerns you the most?
That's a great question. My personal opinion on that is I think inflation has, the most near-term focus on it. I think the data coming out around CPI and PPI is very keenly dictating Fed policy right now. Yesterday's minutes kind of alluded to the fact that taper is on the menu for this calendar year. And so equities are supported by accommodating Fed policy, right? And so if that has to get unwound, there will be some, near-term paranoia as to how that sifts through the system, given the Fed has been so accommodating since the pandemic era that we've been in.
All right, Eric, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Much appreciated. Thank you, Jill.